I do think that a decline of 20% will be accompanied by an extreme amount of stimulus that may actually reduce the pressure on equity markets.
Physical silver and gold in your hands, personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com.
Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update. And back with us today is Tavi Costa from Crescat Capital. Tavi, thank you so much for joining us today.
Thanks for having me.
All right, now I first wanted to talk about the stock market and actually the markets around the world, because you have noted something very interesting, that right now we're seeing the Chinese stock market crash, or at least fall a little, and that can actually be a warning sign that a crash is ahead for the rest of markets around the world. So can you expand on what exactly we're seeing right now and why it is concerning?
Yes, I think there's a lot of issues, especially with the valuation problem that we're seeing. And when you start hearing when fundamentals don't matter, you got to be careful. I think what's going on with this divergence with China, which also preceded other sell-offs like we saw in the fourth quarter of 2018, and then even prior to the pandemic crash of March, we're seeing this again today. Certainly, it really feels like something is brewing under the surface, as I said in my post. I think there's a lot of issues regarding liquidation of funds that are having problems either with valuations or just swimming naked in general. And so I think the over a decade period of easy monetary policies have really exacerbated those issues that we're seeing now in regards to frothiness in the system. And so one of the major, I would say, problems that I see is very related to how Wall Street analysts have been factoring in estimates for earnings, which I think are completely out of touch in regards to where we are in terms of reality of the economy. Some of the estimates that we're seeing for either small caps or NASDAQ or the FANG stocks, technology companies, market as a whole. For the first time, we're seeing estimates now that are supposed to be, well, first of all, we're coming off very depressed earnings, but by the end of the 2021, we're expected to be at earnings 40% or 30% above the prior peak. I really think that that's a very large stretch to what might happen here for a few reasons. Number one, I think there's a very high probability that we may continue to see issues with supply shortage and even labor shortage that may cause price of goods to continue to rise. So where a lot of people see those issues as transitory, I think it's a lot more permanent than most may think. And that is related to a lot of it, the natural resource industry, where you're seeing commodities supply shortage and causing prices of goods and services to rise. Even services are rising too. And so that issue on its own it should impact the margin of companies. We may see actually at the beginning an increase of prices, but then we may see labor pressure going forward as well. So at some point it will hurt the margins of those businesses that are now expected to be at peak margins by the end of 2021. So those estimates and models that they are using seem extremely stretched to where I think they're going to fall into. And the second thing I would point out is in terms of the tax situation that we may see in the following months or years in regards to a taxation given the level of debt in the government that we tend to see every time government debt rises, given a geopolitical event or just levels of debt that have been magnified by an economic recession. What we'd like to see is actually tax rates rise especially for the households. And so those may have an impact on earnings for corporations. And so we expect even corporate taxes to rise. I think, are not factored in at all for estimates. So there's a lot of issues, in my view, in regards to equity markets, where we call this rotation out of equity markets to commodity-related investments much more attractive given where we are. And remember, when cost of capital begins to rise, which is kind of the case here, what you start to see is that profitability begins to matter. And so more and more, I believe we're entering a regime where making money finally is relevant. So in my view, I think a lot of companies with very high multiples and in my view also extremely unrealistic estimates will have issues to deliver those results in the following months.
Now, I'm hearing a few people saying that kind of leading up to the end of the year, we could see equities continue to rise, but then having a crash in the summer or a little bit closer to the end of the year. Is that what you're seeing? Like, what is your time frame with respect to when we could see equities pull back or actually crash?
Look, I think, we are positioned to the short side, so I can only speak for how positioned I am in terms of conviction to anything. However, I do think that a decline of 20% will be accompanied by an extreme amount of stimulus that may actually reduce the pressure on equity markets if we do see a crash. I think it's difficult to see a deflationary bust when you have unlimited dollars being printed left and right. And so I think it's the whole reason why I see a greater probability to us entering a long-term inflationary problem in the following years, given the combination of fiscal and monetary policies that have to be in place. Otherwise, we may see the real output gap of the economy and other issues begin to really impact markets and financial markets as a whole. So I think in terms of positioning, if we do see a deflationary bust, I may actually, appreciate in a way of actually making money out of that trade, given my short positioning stance right now. But honestly, I think it's going to be difficult. I think the greater probability is that we may see a 20, 25, even 30% decline on a more severe environment, and then the Federal Reserve and the government will have to intervene in a large way. And that position is exactly why I think that there's a large probability that gold and precious metals may start disconnecting from the equity market. And that's given not what happened in March, which was a liquidity crisis, but much more for the reason of investors knowing what it may happen if we see a 20+% decline. Is that, if we saw money printing to the degree of about $3+ trillion in a year, we may see double that amount or just a significant amount or very similar to what we saw, which may create a tailwind for precious metals as a whole. So I think there's a high probability that the scenario that we may see that may initially be seen as a liquidity problem, which may see a liquidity problem, is maybe also masked by an incredible amount of monetary and fiscal stimulus that may create actually investors to buy into precious metals. So much more of a believer in this environment right now that we're in of buying gold, buying precious metals, especially relative to the equity markets. So now for timing it's difficult. I don't know what the timing looks like. I can only speak for my positioning right now, which that's the case. We're short a few selective names in the equity markets. And if you look at, if you're actually managing a portfolio, looking at positioning in places like tech companies and a few software businesses are already declining significantly from their peak. You can look at the divergence even from the ARK ETF relative to NASDAQ, which is still near all-time highs, or some other software businesses in general outside of the ETF itself of ARK. Just looking at individual names, you may see some of those big winners of 2020 actually beginning to diverge relative to the overall market. I think those are very important signs. that we may see either a change of leadership or maybe a little bit of a problem with the speculation. So speculation has been a big part of this market and euphoria, and a large participants in terms of retail investors in the last few months. And I think it's very difficult to see that persisting on the long term. So it's important to be positioned with hedges, not only being long commodities. In my view, I think it's a great position to be long commodities, but also have some hedges on the short side of what we could see here of a significant pullback in equity markets. I don't think it's going to look like a Great Depression, anything like that. But I think there's a likelihood of a 30% or so decline in equity markets is fair, given the valuations where it is, given the sentiment. No one is expecting it. Again, I don't need to be right on this in the short term. If I'm wrong on this, I really think it's because of the level of intervention by the government, which may give another leg up for a lot of the tangible assets that we're seeing and hard assets that may take a nice benefit from those policies.
And we are seeing a turnaround in gold and silver recently in the last week and a half or so. Do you think this is the start of the next leg up?
I do. I think, if you believe that and identify in different ways of looking at the macro environment and the factors that drive gold and silver prices, it looks like we are at the beginning of this resuming period from the secular bull market that we thought we were. It's interesting to me to look at miners to gold ratio that have been rising recently and breaking out in the shorter term frame. And I think that that's a very important sign of investors beginning to go up in the risk curve and look for other parts of other position alternatives in this space. And so I think it's an important part. I mean, I published recently what I think it is, very classic early signs of a commodity super cycle in my view, which is similar to what we saw in 1970s and early 2000s. And I'm referring to the labor markets and how constrained it is today to find labor for a lot of those producing mines and developing mines, exploring mines. It's been very difficult for the natural resources space to look for expertise to work in their businesses in general. So I think that that's a big sign of the shortage issues that we're seeing in some parts of the market. And I don't think that's transitory. I think, sure, there's a degree of transitory forces due to the pandemic, but the pandemic really intensified some of those long-term trends that we were seeing in regards to this reduction of in the labor markets of natural resources at the same time as the underinvestment that we've seen so far in the space. So I think it's about time to see this sort of a quiet move in gold and silver, not with a lot of sentiment shift. Sentiment was extremely negative. Even in our last interview, I remember very well, everyone was very negative about gold and silver. That still is kind of the case. I don't think the sentiment has changed, which is great for a market timing perspective. And I think that we are about to see a turn here. We're seeing even GDX today was up, even though equity markets look incredibly weak. That is another very strong sign in my view. And it's been a while that we're seeing some of the even exploration names holding up very well too in the last few months, even since August when this correction really started in the whole precious metal space. But some exploration names actually continue to rise regardless. Sure, pick your winners, but I do think that the industry as a whole is not as bad as a lot of people are picturing this as. And so, if you look at GDX or just the miners as a whole in terms of the quarterly basis, they have barely really sell off. And again, when you look at that, I really think that we are probably at the beginning of another leg up here. And, for me, it's just in the middle of this bull market, and investors that really take advantage of those pullbacks of 20, 30%, or so. Right now we saw somewhere close to 20%, but in '08 we saw 30%, and those investors that took advantage of that liquidity environment, were able to really make money all the way to 2011. I think we're still at the beginning of a bull market for precious metals, and I'm very bullish.
And I know we touched on this in our last interview, but it's really intriguing, something that's happening right now. And you've really talked a lot about this, how we're seeing the commodities to equities ratio at a historic low. And this is if you take the GSCI commodity index and divide it by the S&P 500. And it's like, yeah, it's a 50-year low right now. I mean, that should just be so obvious that it's like, wow, it really looks like commodities are so undervalued right now compared to equities.
And, it's been the case for some time. I've seen people posting this chart, perhaps even a year or so ago. And, we're still seeing equity markets continue to rise. And really, it's almost like the two extremes of not only commodity-related investments being extremely cheap, but also equity markets being historically expensive, as we are talking at the beginning of this interview. Now, I think this rotation out of a record overvalue equity market towards perhaps a very also historically cheap sector as a whole, if you call it the commodities as a sector, an asset class, which has been forgotten by capital allocators, especially the large ones, pension funds, not even allocating money towards commodities. For me, that ratio of commodities to equities, it really is right in between the two narratives that we see that are so prevalent today. And I think I discussed this in our last interview, the Roaring '20s, which I think there's a lot of flaws in that narrative, but also the second one, which is this forthcoming liquidity crisis that we could see regarding this reckoning moment of the valuations in speculative bubbles and among a lot of assets outside of the commodities space. And so, and that is, the commodities to equity ratio is right in between those two. And that's the right positioning, in my view, for a lot of investors looking for the next 5 to 10 years, because that's really how, if you look at that chart, how the development of the bull market for this ratio to rise really takes a while in order to work. And a lot of that has to do with energy, oil prices and energy prices in general being so low. And recently we're seeing sort of an inflection point since elections where a lot of the commodities and really value stocks have been doing really well. I think that is a regime change, and a lot of people are seeing this as perhaps something that may retrace a little bit here, given the move that we had recently. I actually think that there's a big chance where commodities may be entering a bull market in a very big way. And, for me, this has a lot of implications in regards to the policies. Again, it goes back to what the Federal Reserve and the government are doing. The policies we're seeing force investors to buy tangible assets that drives commodity prices higher. And also you start seeing inflationary forces. And, along with the labor market shortages that I was referring to, I think there is a big chance, and the pandemic problem, which I also said in another interview with you, in regards to the studies in the 1919 Spanish flu, when we saw a shortage of raw materials that really pushed consumer prices higher given the supply constraints. I think we're seeing something similar today. And on top of it, we're seeing government policies that really discourage people to go back to the labor market. And so this move out of the labor market is also creating a labor shortage, which forces companies, regardless if it is goods or services, to actually increase their prices. And so we're seeing a pretty interesting environment that a lot of people, for some reason, like to see it as a more of a deflationary environment. I am on the opposite side. I'm seeing a wealth transfer from the government to the people. I'm not seeing an improvement organically speaking, but certainly this where the private sector looks much cleaner than the public sector and may actually create a consumers who spend money in the following months in an environment where commodities and supply in general is very constrained. So we may see prices rise. Some may see this as a transitory issue. I don't think it will be as much as I think it's much more permanent than most believe. And so, again, it goes back to this commodity to equity ratio. I think it fits that environment. If commodity prices rise and you begin to see, really margins being squeezed, equity markets are going to have issues with that. So that's, I think that the probability of that commodity to equity ratio at a 50-year low begin to work is very, very high relative to even 6 or 12 months ago. So this is precisely how we are positioned, but with a much higher weight. And I would say the majority of our positioning right now is on precious metals, especially given the pullback recently.
Now, you mentioned how the rise of prices, some people might think it's just temporary, right? And for example, the Fed's saying maybe there's going to be a little bit of inflation, but it's going to be temporary, right? So do you see the inflation we're seeing right now? We just got the CPI. It was the highest monthly inflation we've had in 2.5 years. So do you see that continuing to increase, or will it just be temporary?
Well, first, I think that the CPI is massively understating, and I'm not trying to bring up any conspiracy thoughts or ideas of why the government is doing this, but certainly is massively understating what the real inflation in the system really is. Just look around you, and you may see that grocery costs or costs in grocery stores, and almost everything that you're buying today is about 10% higher in prices than what it was a year ago. I do think that you have, as an investor, you have to think about in probability terms. And so do we have the recipe for a major deflationary environment? We could see if the equity markets falls apart and for some reason the Federal Reserve and the government isn't able to do the policies that they have been doing so far, which I highly doubt. There is a chance for a deflationary environment right there. But I think, in my opinion, there is a much greater probability that we may see a continuation of those policies that will create inflationary forces. So it's almost like we have a deflationary setup being paired with truly unprecedented inflationary responses. Okay, so how do you position for that? Because that's the bottom line. We can talk about the two, but how do you position? I think it comes down to buying commodities in this environment that are incredibly cheap and may fall less than the overall equity market given the valuations, relative to being very bearish in some of the high-tech, high-multiple names that may have issues in an inflationary environment. A lot of people forget to look at the decades that we've had, so those very long-term inflationary trends, which one of them was in the 1910s and the other one was in the 1970s. And both of them, the median CPI, which again is not a perfect gauge, but is one way to look back in history and see where some sort of gauge of where inflation was back then, was running at a median basis at about 6% for the entire decade. And those are the only 2 decades that we saw such an increase in inflationary forces. We did not see that in the 40s. In 40s, we saw some sporadic moves up, but not the entire decade. And so those 2 decades, what is important is to see the performance, the annualized performance of the equity markets. It was just about 1%. And then when you include the inflationary forces, you easily see that real returns actually negative. So I think that there is, going back to your question, I think there's a very high probability we may be entering and triggering a long-term inflationary problem as we see investors hoarding hard assets and creating a self-reinforcing loop of inflationary forces with higher prices of consumer goods and services, and even commodity prices that are rising as well. So that's what I see. I think. I think that's the most appropriate way to be positioned today is really look for cheap, tangible assets that continue to show attractiveness relative to high multiple stocks that we see in the tech space and other places where I think are just unreasonable.
All right. Well, Tavi Costa, thank you so much for your insights today. Before we let you go, if our viewers would like to hear more of these interviews, they can hit the subscribe button and the bell icon so they'll be notified of all the new interviews we're doing. And if people would like to find you, where can they find you online, Tavi?
Sure, they can find me on Twitter, just at Tavi Costa is my handle. I also post stuff on LinkedIn, and Instagram is at Tavi Costa Macro. So you can find all the research at crescat.net. There's quite a lot of letters that we write and how we are positioned, how we are implementing these ideas. And so you can check that out and see more detailed analysis of exactly how we are positioned today.
Any last thoughts before we let you go?
Well, look, I think the last thought that I may offer is really in regards to what we may see of opportunity in terms of the discovery and exploration space here in the mining industry of precious metals, especially. There's quite a lot of investors buying, starting to buying into the precious metals idea. But not a lot of enough investors really going down deep in the deep value opportunities in the exploration and discovery space with a very focused, very geographically focused strategy. And I think that's really where the opportunity lies ahead in terms of positioning again. At Crescat, that's certainly what we're doing. And I think owning gold and silver in the ground is one of the most levered ways of taking advantage of being early in the precious metals cycle. In my view, that's one of the most attractive ways to be exposed to this idea. So I think we're about to see another run in those stocks in the next 3 to 6 months.
All right. Once again, Tavi Costa, thank you so much for your time, and God bless.
Thank you.
Physical silver and gold in your hands. Personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com.